Good morning, everybody, and welcome to the Siler Wealth Management video blog. Today is Wednesday, November 18th, and overnight we saw that law enforcement in Paris looks like they have secured the people who were the masterminds behind the Paris attacks of last week. Now, it goes much further than that. We all know that. We know that this is a war against these radicals, and I know that all of us would love to see our president step up and say some stronger words, okay? But, and look, I've not been a fan of what he has done. But as an American, we have to stick together on this. And there may be something else going on that we don't know about, although our government just tells everything. But anyway, look, we have to hope that our intelligence, our armed forces, our great men and women that protect us will be out there, and hopefully with the right people running the system, we'll be able to take care of many of these problems. I don't think that terrorism's never going to go away. There are always going to be radicals, and there are always going to be certain groups of people that can't stand us, and that happens. And one thing I have to tell you, as I mentioned this on Monday's video, I've been in this business 27 years. I've gone through recessions. I've gone through financial collapses. I've gone through wars in this business. I've gone through the worst terrorist attack in the history of mankind in 9/11. And, the common theme in all of this is that usually when you sell after that happens, it's usually the wrong time. So what's interesting to see is that our markets are hanging in there very well. And so are the European markets, for that matter. I mean, the Paris markets were down a little bit, but that's certainly to be expected. If something were to happen here in our soil, Wall Street would drop, and that's understandable. But then what you do is you look for opportunity at that point, because usually, and I'm not going to give you a straight percentage, but most of the time, these are very short-lived and create opportunity. So what's happening now is that you see that the euro is dropping in value, which makes our dollar stronger. So it is certainly, when our dollar gets stronger, it does have a negative effect on corporate earnings for multinational companies. Okay, let me make sure you understand that, because their currency is weaker in Europe. Our currency is stronger. Our export, the money we get in for our exports, are less than we would normally get. We've had this problem now for a year or so. In fact, we're seeing that on the quarterly reports, the last earnings reports that just actually concluded a few weeks ago. Many companies like IBM, like Johnson & Johnson, like General Electric, were all saying, hey, we would have done 7-8% better, but currency weakness abroad hurt us, okay? Look, strong dollar is great for many things. It's not great for multinational companies who do a lot of their business exporting. When you look at General Electric or IBM, that's probably 50% exports. Okay, so that being said, listen, we are Americans here. If you're patient, I think that we'll have a resolution to this somehow, some way. There's some great ideas out there, and we do have great minds working for this country, and we'll figure it out. So let's move on, because this is a very critical time of year when it comes to capital gains taxes or capital gains distributions in mutual funds. And this is a somewhat complicated theory. I'm going to try and knock it out. Look at my timer. I'm going to try and knock it out in 4 minutes or less, okay? Mutual funds, which is a basket of stocks, bonds, a basket of investments that is managed by a money manager. You buy a share and you own a piece of all these investments. Could have 200 investments in this basket. Okay. They buy and sell within that portfolio all year long. And they have to pay out if there are capital gains, meaning there are some funds out there that say, hey, I'm going to go ahead and sell my Apple I've had for 3 years and just to secure the profit. Well, you as a shareholder of a mutual fund, you're responsible for any net gains, capital gains. The problem is, if you buy a mutual fund today or tomorrow or any time before they pay that capital gains, which is usually the first or second week in December, you could be down. Let's say you bought this mutual fund today. You could get a nice capital gain that you have to pay taxes on. and you haven't made any money in the fund. It doesn't matter how long you've owned the fund. If you've owned it for this year, you're going to get distributed a capital gain if that fund has capital gains. Now, tax efficient funds don't usually have high capital gains, but if you have a hyper growth fund, the guy who's buying and selling a lot of investments within the portfolio, he's going to create gains and losses, but at the end of the day, there may be a capital gain. So, here's what can happen is that you can have this mutual fund all year long, and the net asset value of the assets inside that mutual fund go down in value. Like our market's been down this year. Bonds are down, market's down. So you could be down, but yet he took profits in the good stocks, Netflix, Apple, all right, Amazon. He took profits in those. So he may be down in everything, but took profits in those. You could be down on the fund and have to pay taxes on a gain. So it's not tax efficient. And our advice is you can call before you go out and buy a mutual fund. If you buy the XYZ growth fund, I would call and ask them if they have a capital gain figure. And they'll say, yes, we believe it's going to pay a 2 or 3% capital gain. And then you determine whether you want to eat that in your taxes, because you could own the fund for a day and have to pay taxes for a whole year. Okay, it's confusing, but it does happen. Also, that's not applicable if you buy it in a retirement account. So it doesn't matter. You can buy the fund anytime because that capital gain is not taxed. Okay, it's tax deferred. So be aware of capital gains. The only mutual funds we would buy today are funds that are not paying capital gains and or put them in retirement accounts. There's another way. If you want to be invested, you don't necessarily have to buy mutual funds. You can buy exchange traded funds, which are it's a hybrid mutual fund. It acts like a mutual fund. It's got the basket of stocks or bonds or portfolio in there, but they're not managed. They're not actively managed. So they pretty much hold those securities for a quarter. So their capital gains usually are very, very small. And what you make money in is you buy them like a stock. So if you buy it at 20, you hope it's 22. You sell it. That's your capital gain. All right. So that's capital gains. Usually pay out first, second week of December. So before you go out and buy a mutual fund in a taxable account, you can call that mutual fund company. Say, when you pay your capital gains, and how much are you going to pay? If you don't know, call us. We'll take care of that for you. We'll see what's going on and make sure that you don't get an unexpected tax hit come April 15th next year. In the meantime, I did it in about 4 minutes or less. Thank you very much. I know it's a lot to take in. If you have questions, you can email me, stockdr.com. You can message me on Facebook. You can call my office, 407-831-8002. The month of December is a really good month for us to meet with new people, for new potential clients. So that's a really good time for you to come in and let's do a portfolio review and look at it, because things slow down December 4th. So that's great. So you can call and set your appointment for December. If we can get you in sooner, we will. But in the meantime, thanks for joining. Please share the video. This is great information that not everybody talks about. And again, keep the faith, all right? We have some great people working for us, and I think that we'll be okay. All right? You guys have a great day and a great rest of the week.